Have you ever wondered how startups are valued? It's a complex process with multiple methodologies at play. Today we'll delve into two of the most common methods: the merchant banker valuation and the discounted cash flow or DCF method. The merchant banker valuation, often employed in the early stages of a startup, is an art as much as it is a science. It involves subjective judgment and a deep understanding of the market. Merchant bankers or investment bankers use their expertise to estimate the value of a startup based on factors such as the business model, the management team, the competitive landscape, and the growth potential. To illustrate, imagine a startup in the burgeoning field of artificial intelligence. The merchant banker might consider the expertise of the founding team, the uniqueness of their technology, and the potential market size for AI products. The assessment is not purely on numbers, but rather on the potential of the startup to disrupt or lead in its chosen market. On the other hand, the discounted cash flow method is a more analytical approach. It estimates the value of a startup based on its projected future cash flows. These cash flows are then discounted back to present values, taking into account the risk and the time value of money. Consider a startup that has a product already in the market. Based on their sales forecasts, one can estimate the future cash flows. If we assume a discount rate, which is often the rate of return required by the investors, we can calculate the present value of these future cash flows, hence arriving at the valuation of the startup. However, it's important to note that the DCF method can be quite sensitive to the assumptions made. A slight change in the projected growth rate or the discount rate can significantly alter the valuation. In summary, both the merchant banker valuation and the discounted cash flow method have their places in startup valuation. The former is more subjective, relying on the expertise and judgment of the merchant banker. It's often used in the early stages of a startup when financial data is limited. The latter, on the other hand, is more objective and analytical, relying on financial projections and discounting techniques. It's often used when a startup has a product in the market and some level of financial data is available. However, it's crucial to remember that no single method can capture the full complexity of a startup's value. Often, a combination of methods is used, and the resulting valuation is more of a range than a precise figure. After all, the true value of a startup is ultimately determined by what someone is willing to pay for it. And that, in the end, is more art than science. Another popular method in the world of startup valuation is the revenue multiplier method. Unlike the previous methods we've discussed, this one values a startup based on its revenue. Here's how it works. A multiplier, which is often based on industry averages or comparable companies, is applied to the startup's revenue. This gives us a valuation figure. The revenue multiplier method is simple and straightforward, making it a favorite of many entrepreneurs and investors. However, it's important to note that this method may not accurately reflect a startup's potential if it's in a high-growth phase or if it's not yet profitable. As with the other methods, it's best used in conjunction with other valuation methods to give a more rounded perspective. To sum it up, the revenue multiplier method is a quick and easy way to get a ballpark figure, but it's not without its limitations. Now you might be wondering, so which method do investors prefer for fundraising? Well, it's not a one-size-fits-all answer. Both the merchant banker valuation and the discounted cash flow method are widely used in the investment community. The choice of method often depends on the stage of the startup, the nature of its business, and the preferences of the investor. However, it's safe to say that a combination of methods, including the revenue multiplier method, is often used to arrive at a valuation range. This highlights the importance of understanding the different valuation methods and their appropriate usage. Each method has its strengths and weaknesses, and understanding these can help in negotiating a fair and realistic valuation. In the end, the choice of valuation method is as much an art as it is a science, and the right method is often the one that gets the deal done. It's crucial to remember that valuation is not just about numbers, it's also about the story behind those numbers, the potential for growth, and the mutual agreement between the investor and the entrepreneur.